Hello and welcome to part 4 of limited company accounts. In part 3 I didn't manage to squeeze all the content in, hence I've moved it over to a part 4. So in part 3 we looked at the notes to shares and we looked at calculating dividends, and here in this video we'll continue with the next point on the list, which is debentures, I believe. Okay, so again, something else that you need to be aware of in limited company accounts are debentures. So debentures are simply a long-term investment, okay, where a company, what they will do is just how shares are offered to investors. Bonds are also offered to investors, okay. So shares are offered to investors. If they take them up, then you become a shareholder. Okay, you become a shareholder where you expect to receive a dividend. Okay, and when bonds are offered to investors, if an investor chooses to take that up, you become a bondholder. Okay, so with shares, you own part of the company, you have shares in a company. As a bondholder, this is actually a little bit different, where you have given your money to the company in return for interest. Okay, in return for interest. So effectively, you are the way I like to look at it is you are effectively like let's say a private bank. Okay, you're like a private bank. You are you've invested your money into a business in return, in exchange for interest. Okay, so it is a long-term investment. Now, investors, obviously, they can choose if they want to take up the issue of bonds or not. They leave their money in the business for a fixed period of time in return for interest. It works in the same way as a loan. If a business wants to take money out from a loan, you'll have a loan for 5 years and you have the rate of interest. With bonds, it's the same thing. You put your money into a business for a certain duration in return for interest. Same with a loan. You need to pay that loan back, and you probably will pay that loan back, over a period of time. With a bond, it is redeemed at a particular date. They call it the redemption date. Okay, so let's say you took the bond out, you issued the bond in 2010, and it's a 5-year bond. That bond needs to be paid back to the investor in 5 years' time. Okay, so that is what is known as a redemption date. It can be paid back on that date. It can be paid back in small amounts. Okay, but it's going to be redeemed by that date. Again, with a loan, you need to calculate interest, and how you would calculate interest for a loan, it is the same way for a debenture. So it's pretty straightforward. You have the rate of interest, you have the loan or the bond, and you just times the two together. Okay, if it's going to be that you took the bond out halfway through the year, so only for 6 months, then you do 2%, for example, 2% of 10,000 divided by 12 times 6. Okay, if you took the bond out for the last 3 months of the 12-month period, then you do 2% of 10,000 divided by 12 times by 3. So simply on a full month basis, on a full year basis, or a pro rata basis. Okay, so I'm not going to go into that because it should be pretty straightforward. You should know how to calculate, basic interest on a loan or debenture. It doesn't really make any difference. One thing to note is that for limited companies, if you are financing a loan, i.e. you are paying interest on a loan, or you are paying interest to debenture holders, then they are treated as a finance cost and they are not treated as a typical expense. Okay, it is still an expense, it's still a cost to the business, but in terms of limited company accounts, the income statement has a slightly different format towards the end. It doesn't go in finance, interest doesn't go as an expense, it is treated as a finance cost, and that is a subheading on an income statement, of which we will have a look at some point. Okay, but just worth noting, don't put it in expenses. Okay, it comes, after your profit from operations, which is you just Google limited company income statement and you will see finance costs on there, and it just needs to go into that particular category. But like I said, keep an eye out for the forthcoming videos, and I will hopefully cover that off in part 5 or part 6 to limited company accounts. Okay, the next again to note is called share capitalization. I mentioned this when looking at the bonus issue of shares. Okay, so I don't want to complicate things because shares it can get complicated, and I want to try and keep it as simple as possible. So if a business sells stocks at par value or at nominal value at the base price, they are going to sell those stocks and they are going to receive money. So expect when stocks are sold that ordinary shares will go up. Okay, the value of ordinary shares will go up, and money in the bank will also go up. If you're selling stocks, ordinary shares will go up because you are issuing more shares, and the money that you will have in the bank will also go up. Obviously, bank is a debit, share capital is a credit. Okay, bank is a debit because it's going up, and share capital is a credit because capital is going up. Likewise, when you sell premium stocks, so shares above par value, then cash is received, so bank goes up, and the premium share premium will also go up. Share capital will go up because, as you know, share capital is a pool where the nominal value goes into there. So if you sell a share at a premium, the par value goes into one category called share capital, and the premium value will go into the premium pool. Okay, so when premium stocks are sold, cash is received, bank goes up, share capital goes up, as well as share premium. When you sell a rights issue and you offer this to existing shareholders, you sell shares, so cash is received. And again, it depends. If you sell the rights issue at par value, then share capital will go up. And if you sell the rights issue at a premium value, then share capital will go up and share premium will go up. Okay. This particular slide is going to focus on a bonus issue, which is a bit more complicated, and these are the rules of limited company accounts. Okay, so what happens when you have a bonus issue? Because we talked about a bonus issue before, and we said that a bonus issue is a free share of stocks, okay, where there is no cost to the investor. However, that still needs to be accounted for. But how do we account for a bonus issue? And the next slide will illustrate this to us. So, when you look at AQA questions, what they will say is, and this only typically comes up when a bonus issue is to happen. So you will be expected to calculate, if a company sold ordinary shares, if they sold premium stocks, if they sold a rights issue, and if they offered a bonus issue. And they mention something along the lines of reserves are to be maintained or used in their most distributable form. Okay, what that means is reserves are used in a very particular way. What are reserves? There are different types of reserves. There's two that you need to be aware of, and they are capital reserves and revenue reserves. Capital reserves is basically a pool of cash, okay, on the books. It's a on the books pool of cash which arises from from capital activities. So for example, if you sold a vehicle or land and buildings and you made some money on it, then the profit on disposal goes into the capital reserves pool. Okay, and that has certain uses. Likewise, if you sell shares at a premium, any premium if you sell the stock for above par, the premium cash on the books, on paper, will go into the capital reserves. Okay, and capital reserves also includes revaluation reserves. So if a property was to go up in value, because obviously property does go up in value, okay, and that was to be realized, that was to be known, that was to be calculated. So a property went up by £200,000 because property prices are going up, then that £200 has to be shown, and that £200,000 goes into a section called capital reserves. So they are capital reserves, and they are anything to do with capital activities. A business has to show these. If you make money or lose money, if you sell shares above par value, and if assets go up in value, it has to go into capital reserves. Okay, you've got to show this additional accumulation of wealth. You also have revenue reserves, which is money that is from operating activities, from your normal trading. And the most common one is retained profit, which is basically profit. A business makes profit every year, and that profit that goes into something called revenue reserves. So every time you make a profit, it goes into revenue reserves, and those profits have certain uses. Okay, one of which is dividends. How does a business pay a dividend? It is not an expense. Dividends are not expenses. It is money that is shared. It is profit that is shared to investors. Dividends is profits that are shared to investors. Now, the question here is, when you have a bonus issue, what do you do? Okay, so an issue of bonus shares is accounted for. This is the question that we're trying to answer. An issue of bonus shares is accounted for by capitalizing them through reserves. So if we have some reserves, what we do is we reduce the reserve to capitalize the bonus issue. So i.e., any reserves that the business has are reduced. So we reduce the reserve and we increase the share capital to offset the bonus issue. So any values in share premium, the rules are to limited company accounts that if you have share premium and you've sold stocks above premium, use the share premium first as an offset and then move to revaluation reserves. Okay, let's have a look at an example because this is where it will make sense to you. So a company has share capital of 50, share premium of 20, and a revaluation reserve of 10. And what they've decided is to issue a bonus issue of £5,000. So what do we do? The rules are use share premium first before revaluation. So you can see here, share premium was 20, it's now come down by 5, and share capital has gone up by 5. So use share premium, reduce this first, and increase share capital. Use share premium first before you start using revaluation reserve. Okay, one goes down and one goes up. One goes down, one goes up. Another example is we've used the same figures. This time the bonus issue is £25,000. So we use share premium first. Use share premium first. So we're going to use the full 20 because we need 25. Use the full 20 and we have 0 left. Then you move to the next reserve, which is £10,000, and we need an extra 5. So we take 5 from there. So we have 25,000 worth of the bonus issue. Use share premium first, then move to the next reserve. So use the full 20, we're left with 0. Then we take 5,000 away from revaluation, and we have 5 left. So you can see share capital was 50, and it's now gone up to 75. A bonus issue is always going to be at par value, never at a premium. It's always going to be at par value. And before a business decides to have a bonus issue, you need to make sure you have reserves to capitalize on that. A business isn't just going to offer free shares. They will be free shares, but they will be shares that are issued to investors from the cash that is for investors. These reserves are for investors themselves or for other uses. Not going to get into the technicalities, just know the process of how you need to do that. Okay, so hopefully that's been useful, and thank you for listening.